Well, today we're diving into some techniques to convert $1,000 into $10,000 with dividend stocks. Imagine waking up every month to $1,000 just for being an investor. It's like a dream come true. In this video, we're going to explore how you can actually achieve this dream and discuss the 3 popular approaches to dividend investing. So let's jump right in. First, let's clarify what a dividend is. A dividend is simply a payment that shareholders receive from the company they've invested in. It's like the company's way of saying, hey, you're part owner, here's your share of the profits. Typically, these payments are made annually, semi-annually, or quarterly, straight from the company's profits. It's no wonder investors love dividends. But here's the thing, while dividends are fantastic, relying too heavily on them can be a pitfall. You see, there are other ways to profit in the stock market, and dividends are just one piece of the puzzle. Strategy 1 is all about consistent dividend stocks. These are companies that have a track record of paying dividends regularly. They might not offer the highest yields, but they're reliable. It's like having a steady job where you know your paycheck will arrive on time. Next up is strategy 2, high yield dividend stocks. These companies offer higher dividend yields, which means you get a bigger chunk of profit. However, keep in mind that higher yields can sometimes come with higher risks. It's like chasing bigger rewards, but with a bit more uncertainty. Lastly, there's strategy 3, dividend growth stocks. These companies may not pay massive dividends today, but they have a history of increasing their payouts over time. It's like investing in a young tree that grows into a sturdy oak, providing more shade and fruit as time goes on. For investors focused on creating passive income from their investments, dividends are often preferred. They provide a regular stream of income, whether it's paid out quarterly or annually, which aligns well with the goal of generating passive income. However, it's essential to understand that both dividend income and capital appreciation have their places in the world of investing. The right approach for you depends on your financial goals and investment strategy. So whether you're aiming for regular dividends or long-term capital growth, there are strategies to help you achieve your financial objectives in the stock market. Number 1 is handpicking individual companies that offer substantial dividends. Many large, well-established companies such as banks, telecommunication firms, or mining companies are known for their generous dividend payments. By selecting a few of these blue-chip dividend-paying companies, you can build a robust dividend portfolio. However, this approach comes with a significant caveat. It requires active management. You can't just set it and forget it with this strategy. Why is it the riskiest? Well, it's because you need to be vigilant about avoiding what we call dividend traps. A dividend trap occurs when a company has been paying dividends for a long time, and investors have come to expect those payments. The company feels pressured to maintain these dividends to keep their investors happy, even if their financial health isn't great. This can be detrimental to your portfolio because the company might be sacrificing its financial stability to keep paying those dividends. While you're receiving a 6% dividend yield, the company stock price could be plummeting by 20 or 30%. It's not a sustainable situation. To avoid falling into a dividend trap, you need to thoroughly assess the financial health of the companies you're investing in. Look at the balance sheets, income statements, and cash flow. Ensure they have the means to sustain their dividend payments without jeopardizing their overall stability. Research and due diligence are key when handpicking dividend stocks to avoid these potential pitfalls. Another common approach to dividend investing is to consider dividend-paying exchange-traded funds. These ETFs are designed to provide investors with exposure to a diversified portfolio of dividend-yielding stocks. In Australia, you have options like iShares ASX High Dividend Yield ETF and the Vanguard Australian Shares High Yield ETF. These ETFs aim to track specific dividend-focused indices and passively invest in stocks that make up those indices. Unlike actively managed listed investment companies, dividend ETFs follow a more hands-off approach. They mirror the performance of their respective indices and don't involve active stock selection or management. As a result, investors know exactly what to expect from these ETFs in terms of their investment opportunities. It's important to note that the primary goal of dividend ETFs is to provide a steady income stream through dividend payouts. While they may not deliver significant share price gains over time, they are designed to offer attractive dividend yields. Therefore, if you prioritize regular income from your investments rather than capital appreciation, dividend-paying ETFs can be a suitable choice. In summary, investors have various options when it comes to dividend investing, including selecting individual dividend stocks, investing in listed investment companies for diversified blue chip exposure, or opting for dividend-paying ETFs for a more passive income-oriented approach. The choice ultimately depends on your investment goals, risk tolerance, and preferences. Overall, there are three main strategies for dividend investing. To achieve a consistent monthly dividend income of $1,000, you typically look at investments like funds, ETFs, or listed investment companies, which often offer dividend yields between 4% and 6% annually. To reach an annual income of $12,000, you'd need to invest between $200,000 and $300,000 initially, assuming the typically dividend yields. However, saving up such a substantial amount of money upfront may not be feasible for most people. Instead, consider setting time-based goals. Ask yourself whether you want to achieve this income target in 10, 20, or 30 years. This approach allows you to break down the goal into more manageable steps. To make the goal more achievable, start with an initial investment, let's say $5,000, and commit to adding it regularly. For instance, if your goal is 10 years, you might need to invest approximately $1,850 per month at a 6% return or $2,041 per month at a 4% return. Consistent contributions over time can help you work your way up to your target. Stretching the timeline can significantly reduce your monthly savings requirement. With a 20-year goal and 6% return, your monthly savings would be around $417. Extending it to a 30-year goal further reduces the monthly commitment to $183 at a 6% return or $425 at a 4% return. The power of compounding plays a crucial role in this strategy. The longer you invest and reinvest dividends, the more your portfolio will grow over time. For example, with a 30-year goal, a substantial portion of your portfolio's value comes from the compounding effect, making the goal more attainable. Your approach should align with your financial situation, risk tolerance, and investment horizon. Whether you're aiming for a shorter or longer time frame, the key is to set realistic goals, leverage compounding, and stay committed to your investment plan. This gradual approach to building passive income can provide financial security, particularly in retirement when you rely on your investments to cover living expenses. In conclusion, the power of compounding plays a vital role in your journey to achieving a monthly dividend income of $1,000. By letting your investments grow and reinvesting dividends over time, you can watch your portfolio value snowball. When your investments eventually reach the range of $200,000 to $300,000, you can make a strategic switch. Instead of reinvesting dividends, you can redirect them to flow directly into your bank account, effectively achieving your income goals. There are indeed various paths to pursue the financial milestone, but the most achievable one often involves making it a long-term goal. You work hard and cover your expenses with your active income while consistently contributing to your investment portfolio, allowing the power of compounding to do the heavy lifting on your behalf. When you reach a point where you're ready to retire or when it aligns with your financial objectives, you can flip the switch and enjoy the fruits of your patient and disciplined investing. If you found this information valuable, please consider leaving a like on this video. It goes a long way in supporting content creators. Don't forget to subscribe to the channel for more insights into personal finance, money management, stock market investing, and other related topics.